Welcome, ladies and gentlemen, from me, Guy Monson, to our regular 6-minute strategy summary. The whisper number for the US CPI print today is around 6.8%, a staggeringly high number and the highest since 1982. For those of you old enough to remember, like me, that was the year when Michael Jackson wrote Thriller and the Commodore introduced its first PC computer, to give you some context. The response of central banks would normally be straightforward, and we've seen a pivot already by Jerome Powell to a tighter policy. But it's been complicated by three factors. First, of course, the ongoing spread of the Omicron variant, highly infectious around the world, and the lockdowns that that's resulting in. Secondly, a marked weakness in US consumer confidence, reflecting probably higher inflation rates and vaccine fears. And thirdly, the likely bankruptcy of the Evergrande property group, the sprawling empire that will probably trigger the largest bank restructuring in Chinese history. What does this mean for financial markets? Well, so far equities are gloriously relaxed. They're trading just 1.8% off all-time highs for the world index. We'll see if that can continue and what the implications for our policy are in the slides ahead. So let's begin by looking at that US CPI number in the left-hand panel at 6.8%, the highest since 1982, and well above even the highest economist estimates from a survey by Bloomberg. On the right-hand panel, you can see that those inflation rates have been mirrored around the rest of the world, with a particularly strong 4.9% out of the euro area. Interestingly, stronger inflation numbers also from China and Japan. In policy terms, though, central banks seem to be holding to that slight pivot towards a more hawkish policy. First of all, Jerome Powell, I think, well overdue, has let go of that transitory word, and he's also talked about the economy being very strong and inflation pressures that are higher. This has been mirrored around the world, with now 12 central banks tightening policy, second rate rises this year from New Zealand and South Korea. But what could complicate this picture and what could potentially alter that trajectory going forward? Well, first of all, we've got to factor in Omicron, a demand shock as some pullback of services occurs, a supply shock as planes and ships are further disrupted by border closures. You can see already the beginnings of this effect from the Global Stringency Index we've looked at in previous reports. That red line for Germany rising sharply to 84.3, and we expect that UK blue line of 46.8 to climb sharply as we factor in Boris Johnson's new restrictions. We're not, though, thinking this is going to be a major change for US policy, and we're still expecting taper by Q2, 2 US rate hikes in 2022 and 3 in 2023. Well, are we confident of that? Because the vaccines still look as though they're comparatively effective. I show this chart here from Moderna, looking at the 3 doses of vaccines and their strength of immunity that they generate. That grey, the first dose, the blue, the second dose, and that sharp uplift in the strength of immunity in that green line for the third dose. And that, of course, is what we're relying on. The second issue I think central banks are going to have to consider is a slightly worrying and sharp decline in US consumer sentiment. I plotted there the Michigan US Consumer Sentiment Index. And it's interesting because it's fallen despite the very high cash balances in terms of money market funds of US consumers relative to their pre-COVID position. I think, though, consumers are beginning to worry about the inflation numbers and once again about the vaccine Delta and Omicron variants. The third and final factor that's going to complicate the picture is, of course, China. We've looked before at regulation, energy, and the impact of the Delta variant, but now we have the likely default of Evergrande, the sprawling giant property group that will probably mark the biggest debt restructuring that China's ever seen. Policymakers are already easing. That will help asset prices in the short term, but the risk of debt contagion is, in our eyes, really quite great. So let's look at asset class performance. On the left-hand side, you can see the World Equity Index for the year to date. Extraordinary, as you can see, it's recovered almost all of the post-Omicron losses that recurred in late November, early December, to end so far just 1.8% off its all-time highs. Extraordinary. But underneath that indices, there's a lot of problems for stock selectors. I plotted on the right-hand side the traditional market cap weighted index, that's where each company is weighted by the size of its market capitalization, against the MSCI World Equally Weighted, where each company is assigned an equal weighting. The difference between the two is extraordinary, almost 8% for the year to date. And that's been a particular challenge for thematic investors like ourselves. We focus on high quality, progressive dividend, cash flow rich global thematic stocks. And that often takes us to mid-cap stocks or not the super caps that have led the index. Is this a policy we should stick with after the underperformance of the major indices? We would argue yes. We think that tighter monetary policy, the challenges we've just identified in this report, in China, in consumer confidence and in Omicron, all argue for some caution and a quality overlay in stock selection. And I think this is probably a price worth paying. Well, I hope that's helpful, and thank you very much.